Hey everybody, Adele Foltz, your professor for Accounting 1. Welcome to some journal entries on merchandising companies. As you read in your chapter, or if you're in a face-to-face class, as we learned about in class, merchandisers purchase goods and resell them. And so the journal entries that we're going to do are going to be from both sides. Sometimes will be the buyer of inventory, and sometimes we will be the seller of inventory. So let's get started. Over here on the left are the transactions that occurred during the month, and we have quite a few of them to get through. So let's get started. And on the right, I have the general journal. Okay, so we're told this is Winter's Hardware Store, and they have the following transactions during the month of May. And at the beginning of May, they're giving us the ledger balance for cash and common stock. We're only going to do the journal entries. In the instructions, it says to also post in addition to journalize. We're just going to learn about the journal entries. So let's talk about May 1st. On May 1st, here, we purchased merchandise on account from Black Wholesale Company for $8,000, terms 110, net 30. Okay, so we purchased this merchandise on account. So we have merchandise that we didn't have before, and we have a new account in this chapter called Merchandise Inventory. That's an asset account. And by debiting it, we increase it. So we're going to debit it and make it increase. And we purchase this on account. So that means on credit. And we're also given some terms which are defined in your book. And we also went over in class, but I'll just talk about those briefly. So since we purchased it on account, that means that we didn't pay for it when we purchased it. So we're going to credit our accounts payable, 8,000. To record inventory purchased on account, make sure you complete your full description, but I am going to put the terms in here as 110 net 30. Okay, 110 net 30. So the 110 net 30 means whenever you see that, the top number here in this numerator means a discount. So this company gets to take a 1% discount. Or we get to take, we are Winter's Hardware. We get to take a 1% discount if we pay within 10 days. And if we don't pay within 10 days, we have to pay the whole net amount. And by net, they simply mean that it's net of any returns or any allowances. But effectively, it means the whole amount that we owe, we need to pay within 30 days. So those terms, even though you see here 110 net 30, they are changeable. So it's whatever the companies agree to. So we could certainly have 215 net 45. So that means we would take a 2% discount if we pay within 15 days. Otherwise, we pay the whole amount due within 15 days. Okay, so we're going to make note of those terms because eventually we're going to pay for this merchandise. And when we pay for the merchandise, we're going to need to take the discount. Okay, so on May 2nd, now we're selling some merchandise. And we're selling it on account, which means we're not getting paid for it, which means we have accounts receivable. And the amount is $4,400 that we're selling it for. Oh, we have new terms, 210, net 30. That's for our customer. Our customer gets to take a 2% discount if they pay within 10 days. Otherwise, they have to pay the full amount that they owe us within 30 days. And the merchandise that we sold had a cost to us of $3,300. So we talked about this, at least in class, or it's discussed in your book. When we are using the perpetual inventory method, every time we have a sale, we need to record two transactions. We need to record the sale and we need to record the cost of sale. So the sale is revenue and the cost of sale is an expense. So on 5-2, we're going to have 2 journal entries. We're going to first record the sale. And so we sold on account. So we are going to debit accounts receivable. That is an asset, and debiting it makes it increase. And that makes sense because our customer now owes us $4,400. And we credit a revenue account. And in this chapter, our revenue account is called sales, $4,400. To record sale on account. And as we said, we are working with the perpetual inventory system or method. And that means that every time we have a sale, we are going to record the expense of that sale. So on 5-2, we have an expense. That expense is called cost of goods sold. That's what we call it. That is an expense account. So we debit it to make it increase and we credit it to make it decrease. So we now have sold this merchandise. Keep in mind, when we buy merchandise, like we did here on 5-1, our merchandise inventory, we when we buy inventory, we debit that account and credit cash or credit accounts payable. And so the merchandise inventory is an asset, so it goes on our balance sheet. We have to eventually move it to expense, which shows up on our income statement, and we do that when we sell it. So that's what we're doing in this transaction. We sold it, so we're going to take it out of merchandise inventory, make it go down, which makes sense because we no longer own it. And we're going to put it in our cost of goods sold account, which is an expense account. So we're going to debit the expense and make it go up. So this is our second entry. We're going to debit cost of goods sold. Again, that is an expense account. And so we want to debit it to increase that expense and match it with our sales revenue. And so we debited cost of goods sold, and we no longer have that merchandise. So we are going to credit merchandise inventory. That's an asset. Crediting it makes it go down. So this is to record our cost of sale. So remember, perpetual inventory, which is primarily what we are going to work with in this class, every time you have a sale, you have 2 journal entries that you must do. One to record the revenue, and then one to record the expense. Okay, and thereby matching our expenses with our revenue. Okay, so that is on 5-2. And then on May 5th, we are receiving a credit for merchandise that we returned of $200. So on May 1st up here, we purchased merchandise, and it looks like on the 5th, we returned some of that merchandise. Maybe it was defective. Maybe they sent us the wrong merchandise. We weren't happy with it in some way, so we returned it to them, and they are giving us a credit. Now, we haven't paid them yet for our purchase of the inventory on May 4th, and I'm going to start some T accounts over here for our receivables and our payables. We had accounts receivable, and this was, it doesn't tell who we sold it to. This was on May 2nd, and we debited that $4,400. Let me erase this here. Whoops. Okay, and let's put some of our accounts payable down here. We had accounts payable to Black Wholesale. Let me try and move this up just a little bit. Okay. All right. And on May 1st, we credited that $8,000. I hope I've left myself enough room here. Okay, so we are on May 5th making a return to them. So since we're returning the merchandise, we no longer have it. So on 5/3, we are going to show that we don't owe all of this payable anymore, right? We don't owe 8,000 because we returned $200 worth of it. So we are going to debit accounts payable. I'm going to put the part of the name on it. Let's see. Oh, it's Black Wholesale. And we're going to debit that accounts payable and make it go down because we returned the merchandise. Then we are going to credit our merchandise inventory. Merchandise inventory is an asset account. Crediting it makes it go down. So we no longer have that merchandise because we returned it to the wholesaler. So this is to record credit for returned merchandise. Notice up here, oops, that's not what I want to move. Okay, up here, we debited merchandise inventory and made it go up, and credited accounts payable and made it go up. Down here on 5/3, we're doing exactly the opposite. We're debiting accounts payable, making it go down, crediting merchandise inventory, make it go up. If we had already paid the bill, I like to talk about this too. If we had already paid the bill such that we did not owe Black any longer, and they owed us, now we can think about that. If we didn't owe them, then they would owe us money back. So we would, instead of debiting accounts payable and make it go down, we would debit a receivable from Black and make that receivable go up. Again, that would only be if we had already paid the bill. In this case, we haven't, we still owe them. So we're going to debit the accounts payable and make it go down. Okay, let's go on to the transaction on the 9th. And on the 9th, we received collections in full, less discounts from the customer that we billed on May 2nd. So let me move this over here. And I just need to move this over a little bit. Where's my mouse? Come on. There we go. All right. So we are collecting from this customer right here. And so they are paying on May 9th within their 10-day discount period. Remember, their terms were 210 net 30. So they're paying within the discount period. So they're going to be able to take a 2% discount. So the way that we do this is the amount that's owed to us is $4,400. And I like T accounts because if they had returned any merchandise or if we had given them an allowance, we would have adjusted that receivable. So I like the T accounts because we can see clearly they still owe us $4,400, and they're going to get to take their 2% discount. So their discount is going to be $88. They're going to get to remove that. And so the amount of cash that they're going to pay and that we are going to receive is $4,312. Now, I always say, take this the easy way, at least until you're good at it. And let's record the easy part. So we know we are collecting cash on this receivable. We have cash, and students always get cash, right? So on the 9th, if we receive cash, cash is an asset, debiting it makes it go up. So we're going to debit cash, $4,312. And I always say we have to record every single one of these items here. So we've recorded number 3, the cash that we received. The amount here that's owed to us is here in accounts receivable. After our customer pays us, even though they're taking the discount, they owe us nothing anymore. So in order to show that this account is paid in full, we're going to credit the accounts receivable and make it go down for the full $4,400, even though we're not receiving $4,400. So let's go ahead and credit our, I'm going to skip a line because I know I'm going to need another debit. We're going to credit our accounts receivable for the full 4,400. And so now we have recorded that item. And so the only thing that is left to record is our discount here of $88. We definitely need a debit. So I'm going to put the debit here. The account that we use is called sales discounts. So I'm going to debit sales discounts. So it's not actually a discount on the sale. It's really an incentive for our customers to pay us early. Keep in mind that we have multiple accounts for sales. We have the sales account. It's a normal revenue account. And so it has a normal balance of a credit. And in our transaction on May 2nd, we credited sales for 4,400. Now, we didn't have any returns from this customer, but if we did, we would have a second account called sales returns and allowances. We will put both returns and allowances. Allowances are effectively a price reduction for something that our customer's not happy about, and we decide to reduce the price, but we're allowing them to keep the merchandise. So a return is when we get the merchandise back. An allowance is just a price adjustment in the cost. So our sales returns and allowances, if sales is a revenue and crediting it makes it go up, when sales are going to be returned to us, we're going to, instead of debiting sales, we're not going to debit sales. Instead, we're going to put that debit here in sales returns and allowances. And it will reduce sales as it should, just like if we had debited sales directly. But then we have this other account called sales discounts. And that is the discount that we give for early payment. It reduces sales. So if sales is a revenue account and credits make revenues go up, then debits should make revenues go down. And in fact, what we did here was debit our sales discounts of $88. And so rather than using one account, we don't do this. I'm just going to show you this and then I'm going to erase it. If we used one account, we would credit our sales 4,400 and then debit our sales 88. This would be our sale. And this would be the sales discount that our customer took by paying early. And then we would have net sales of, 4312. Even if we use 3 accounts, we end up with the same net sales. We would have sales of 4,400, that has a credit balance, and we would have a debit balance in our sales discount. And so we would deduct it and we would have, oh, why do I keep writing that number wrong? We would have the same net sales of 4312. So it doesn't matter whether we use one account or 3 accounts. We end up at the exact same net sales. The only difference is we like to use 3 accounts because we'd like to know and keep track of how much of our merchandise is being returned to us. That would be in our sales returns and allowances. So we put the debits in sales returns and allowances rather than to debit sales directly and decrease it. So we put it in a sales return and allowances, and therefore as managers, we can keep track of how much of our merchandise is returned. And also our sales discount is put into a separate account because we also want to track how well we're doing with this incentive. Are our customers taking advantage of it? Is it working? So we put it in a separate account. So our sales account just has our gross sales, and the things that reduce sales go in their own separate account with a debit balance. Okay, so that takes care of the transaction on 5/9. And then on 5/10, we are paying for the merchandise that we had purchased from Black Wholesale. And we're paying it in full less the discount. So we're paying it within 10 days. Let's switch our colors up here again. So we're paying it here on the 10th within 10 days. So we want to first determine how much do we owe Black Wholesaling? And so that's why I do like the T accounts. So I'm going to look at the balance. We had credited the account 8,000 when we made the purchase, and then we debited it 200 when we made a return. So we only owe them 7,800. So we're going to do the same thing that we did up here, and that we're going to look at what we owe. And we owe, let's make that a little thinner. Okay, we owe 7,800, but we're going to take a discount. It's not 2%. They allowed a discount of 1%. So we have a 1% discount, and that's going to be $78. We're going to subtract that. And so we are going to pay them $7,722. This is the cash that we're going to use. Okay, so I always like to take the easy one first until we get good at it. So on 510, we know for sure that we are going to use our cash of $7,722. So cash is an asset. If we've used our asset to pay this bill, we need to credit it to make it go down. So I'm going to go ahead and credit cash for the amount of cash that I used, $7,722. When I pay this bill, I don't owe it anymore. The accounts payable has a current balance of $7,800, but when I pay it, even though I'm paying less, I don't owe anything anymore. So I'm going to debit this account, $7,800, my accounts payable, to Black Warehousing, Wholesaling. And so we're going to debit that for the full $7,800. It's the full amount that's owed. And so now our debits and credits don't equal. We took a discount of $78. So the question is, what are we going to credit? So this is going to be to record payment on account within discount period. So the question is, what are we going to credit? Well, let me just show it to you visually in a T account. So this was our merchandise inventory for what we purchased from Black. And when we purchased it, we debited the account $8,000 and showed that we had merchandise inventory and assets. So we debited it and made it go up. And then we did a return, and our journal entry on 5/3, we credited the account. So our merchandise inventory shows $7,800. The question is that what it cost us, right? This merchandise inventory account should reflect all of the costs necessary to bring that asset to its intended use, which is to sell it. And right now we're showing that it cost us $7,800, but we just wrote a check for $7,722. So it didn't cost us $7,800. So if we were to credit this merchandise inventory account, now its balance is $7,722, what we actually paid for it. So your credit is to merchandise inventory when you take your discount. By the way, when you are the purchaser of inventory, we call that a purchase discount. So this is a purchase discount. However, when we're selling inventory, we call it a sales discount. And both buyers and sellers treat it differently. If, on the seller side, the seller would show it as a sales discount and debit sales discount. When you're the buyer, you show it as a purchase discount and you credit merchandise inventory, as we did here. Okay, so I'm going to erase that. Well, I'll leave it there for now and see if I need it for additional transactions. I probably do. All right, so we finished the transaction on May 10th. So let's look at May 11th. Okay, that's an easy one. That's from an earlier chapter. We purchased supplies for cash. So on 5/11, we're going to debit our supplies inventory. That's not a merchandise inventory. That's our supplies inventory. You can just call it supplies. We know it's inventory. And that was $900. And we credit cash to make cash go down. So we're just changing one asset for another, debiting one and making it go up to record supplies purchased with cash. Okay. All right, so that was 5/11. We're done with that. So let's look at on May 12th. We're purchasing more inventory of 3,100. So on 5/12, we're purchasing inventory for cash in this case. So on 5/12, we have merchandise inventory. We're going to debit it and make it go up. 3,100. And we used our cash. So we're going to credit cash, make it go down. That's how we make assets go down to record purchase of merchandise inventory for cash. So this was not on account. Had it been on account, we would have credited accounts payable. All right, so we're done with that one. All right, so we weren't quite happy. Let me copy over. Let's move this up a little bit. That'll give us some more room. I think I can move this. Just move it over here. Okay, perfect. And we need another journal entry. This is going to be just a little bit tricky here. All right. Try to make it about the same size. All right. That looks about the same size. Oh, a little bigger. Let me just pause this for a second. Okay, so we're back. So we are looking at the transaction on the 15th. And on the 15th, we received a refund for poor quality merchandise from the supplier on our cash purchase. What is our date on this? On the 15th. So it doesn't explicitly say that you returned the merchandise, but I'm going to assume, oh, it does say that you returned the merchandise. And so you don't have it any longer, and you received a refund for that amount. So you received cash of $230. So if we received cash, we're going to debit our cash. You know what? I'm going to use a different pen because I'm not crazy about that blue. Okay, we're going to debit cash for $230 and credit. So now we have cash that we didn't have before. And we also sent back the merchandise inventory. So we're going to credit merchandise inventory and make it go down to record refund for merchandise returned. Okay, so that was on 5/15. All right, let's move ahead. On 5/17, we purchased merchandise on account from Wilhelm Distributors for $2,500, and now we have credit terms 210 net 30 because we are purchasing it on account. So I'm going to put another accounts payable here, and this is for Wilhelm. And so we have $2,500 worth of merchandise. So we're going to debit merchandise inventory. Make it go up. It's an asset. And we are going to credit accounts payable because we purchased it on account and we now owe for it. And so crediting accounts payable increases it. It's a liability. And we're going to indicate to record purchase of merchandise on account terms 210 net 30. So if we pay it within 10 days, we get to take a 2% discount. Otherwise, we have to pay everything within 30 days. Okay, now we paid freight on the May 17th purchase of 250. So let's just take a moment and talk about that. So they did not tell us this here in this transaction, but they were FOB terms. And the FOB term, if we were the buyer of the merchandise and we were responsible for the shipping, then that must have been sent FOB shipping point. And so as was discussed in your chapter or in class, that FOB shipping point or FOB destination talks about when does ownership transfer from seller to buyer. And ownership, we talk about transfer of title, but title means ownership. So if it's FOB shipping point, then the seller just needs to deliver the merchandise to the common carrier. And once the common carrier has it, the trucking company, the dock, if it's going overseas, once they deliver it to the shipping point, then the seller transfers ownership of those goods to the buyer. So then the buyer, if the buyer owns the goods while they're in transit, then the buyer is responsible for the shipping. So they didn't tell you here, but this would have been sold FOB shipping point because we know that that we are paying for the shipping here on, let's see, it looks like it is the 19th. We're paying shipping of 250. By the way, let me put my 2,500 in here in my accounts payable account. That comes from my journal entry over here on the 17th. Okay, so what do we do with that freight when we're responsible for purchasing it? If we are the buyer of merchandise, what we said is that merchandise inventory needs to include all costs necessary to bring that asset to its intended use, which is to sell it. So we debited merchandise inventory for our invoice cost of 2,500. But then since we had to pay freight while it was in transit because we owned it, we add that to the cost of our inventory. How do we add that and include it in the cost of our inventory? We do that by debiting merchandise inventory and making it go up. So our journal entry here, let's see, did we pay it? Yep, we paid it in cash. Our journal entry here would be on 5/19 to debit our merchandise inventory and make it go up and include the cost of this freight in the cost of our inventory. So we're going to debit merchandise inventory for 250 and we paid this bill, so we're going to credit cash. Had we not paid the bill, we would have credited accounts payable. To record freight paid. Okay. Whoops, EI. To record freight paid on 5/17 purchase. So once again, when we talk about merchandise inventory, it's an asset, and so it must include all costs. If we had to pay, for a special insurance policy while it was in transit, that would not be debited to insurance expense. It would be debited to merchandise inventory. So we could include it and add it to the cost of the merchandise inventory. Also notice up here, when we got to take a sales discount, we credited merchandise inventory. So sometimes when we say it includes all costs necessary, if we get a discount, it reduces the cost of the merchandise inventory. So that's why we credited it and made it go down. Okay. All right, so next transaction is on the 24th. Now we sold merchandise for cash of 5,500 and the cost of the merchandise sold was 4,100. All right, so this was not on account. We actually got paid for it, so we got the cash. But once again, when we are recording sales, whoops, under the perpetual inventory method, I don't have enough room here. Let's see, what am I going to do? Well, we'll just move this up a little bit while we're doing this. Okay. So we are recording under the perpetual method. So we sold merchandise for cash, and we have to record two transactions. We have to record first the revenue, and second the expense, which is called cost of goods sold. So on 524, we have we sold merchandise for cash for $5,500. So we received cash. We're going to debit cash and make it go up. And we have to record our sales revenue. So we're going to credit sales and make it go up to record sales for cash. Okay, so that's our first journal entry. We record a credit to sales and make it go up. And now we need to also record the expense of that sale and make it go up. As we said, the date is the same and the account name is called cost of goods sold. So we're going to debit that account. It's an expense account for the amount that those goods cost us, which was $4,100. And we're going to credit our merchandise inventory because we no longer have it. Our customer has it. So we're going to credit merchandise inventory for $4,100 to record cost of goods sold. Okay. And then we're purchasing more inventory from Clasps Inc. for $800. Terms are $310, net $30. So this is on, what's my date? On 5/25. So we're going to have another accounts payable. And this one is to Clasps. So I'm going to keep it separate. And that merchandise was $800. All right. So we purchased it on account. So we're going to credit accounts payable for $800 and debit merchandise inventory because we now have new merchandise inventory. So debiting that asset makes it go up, and credit accounts payable is a liability. Crediting it makes it go up to record purchase on account. And remember, I do like to put the terms in here, $310, net $30. And except I don't think I put it in on that other one, but we'll look it up when we're ready. Okay, so then on the 27th, here, you can't quite see the date, but I can. We paid Wilhelm Distributors in full, and we're going to get to take the discount because it was within the time period allowed. Now I have it covered up, but the terms were $210, net $30. So we're going to get to take a 2% discount. We didn't have any returns or any allowances, so we just owe Wilhelm $2,500, and so we owe them $2,500. We're going to get to take a 2% discount. 2% of $2,500 is $50, and so we are going to pay them $2,450 cash that we need. Okay, so as I said, 1, 2, 3, all three of these items need to go into our, I'm gonna have to move that up again. It didn't move, come on. Okay, how about if we move this down a little bit? Even though I'm going to lose the narrative, we'll go back and get it. Okay, So all three of these items need to be in our journal entry. This is the cash that we used. So I always like doing cash first. I think this was the 27th. So let's credit our cash and make it go down for the amount of cash that we need, which is $24.50. We owed $2,500, but when we're done paying this, even though we don't pay the whole thing, we don't owe anymore. So let's debit the accounts payable to Wilhelm for the full amount that we owe, which is $2,500. Okay, so we need an additional credit here for that to balance. And as we said before, what we want to do is to credit our merchandise inventory. So we're going to credit our merchandise inventory for $50 and make it go down. So let's put our credit here to merchandise inventory. And now our merchandise inventory, remember we did have, this was our purchase, and then we had a return. I'm sorry, wait, oh no, that was our freight. That was our freight on the purchase. And then we got to take a discount. And so the cost of that merchandise is, this would be $27.50. We have $27.50 debits here. We have 50 credits here. So that merchandise inventory cost us $2,700. And let's look at that. Is that correct? Well, we wrote a check, one check for $24.50. And then we wrote another check up here. Where was it? $250 up here. We wrote a check for $250. If we add these two together, they equal $2,700. And because we credited this discount to merchandise inventory, it properly reflects the amount that we paid for our merchandise. Okay. All right. So let's see here. So let's go back to, let's try and move this up. All right. So now, okay. We made, oh, this is important. We haven't, I don't think we've had one of these. We made refunds now to customers for returned merchandise. And the merchandise, the returned merchandise had cost $90. So we made a refund to our customer. So let's work on that. Let's see. Let's see what kind of space I can get here. Where's my, there we are. All right. All right, so we're making refunds to our own customers. And so we sold to them, they returned to us, and they also returned the merchandise. So we have 2 journal entries we need to do. When we had the sale, we recorded 2 journal entries. We recorded the sale and we recorded the cost of sale. And now when the merchandise is returned to us, now we're the seller and merchandise was returned, we have 2 journal entries. We have to make our net sales decrease because the merchandise was returned and we're refunding it. And then we also need to show that our expense went down. So we know we credit expense by, or we reduce expense by crediting it. So the merchandise that, the sales that were returned to us, what is the date on this? 5/29. It was $124, right? So instead of debiting sales, remember we talked about, did I get rid of those 3 accounts? We have sales, it keeps our credits. We have sales, returns, and allowances. And that's where we put our debits. We do not put them in sales. We like to have 3 accounts, and then we had our sales discounts. And our sales discounts also have a normal balance of a debit. By the way, as we talked about in class and you saw in your textbook, this is called a contra account. It's a contra revenue account, which means it stays together with the revenue. They go everywhere together, but they have the opposite balance and they reduce revenues. They don't increase it. Okay, so we're going to debit sales, returns, and allowances for the 124 that was returned. And in this case, we're giving cash back. So we're writing them a check. So we're going to credit cash. My question for you would be, what if our customers had not paid us yet for the amount that they owed us? And so we still had an accounts receivable on the books. If we did that, we would credit accounts receivable rather than crediting cash. We would let them take it off the bill before they paid it. So in this case, I'm going to assume that these customers had already paid their bill, so they didn't owe us anything, or they had purchased the merchandise on account to begin with. And so this would be to record merchandise returned for a refund. Okay, so we have one entry, but we know, so we have shown that revenue has gone down. How did we do that? We debited sales, return, and allowances, so we made revenue go down. So the second thing is we have to make our expense go down. That merchandise was returned to us and it had cost $90. So on 529, we're going to debit our merchandise inventory and show that we now have it. It was returned to us. So let's debit that asset and make it go up. And then our expense account, when we're a merchandiser, is called cost of goods sold. We've used this a couple of times, but before we were debiting it and making the expense go up. This time we're crediting the expense and making it go down to record merchandise returned. Okay, we have one more transaction, and then I'm going to make up a transaction because it wasn't covered in this problem, but you really kind of need to know it. So on the 31st, we sold merchandise on account with terms net 30. If it's net 30, that means they don't get to take a discount. They have to pay the whole thing in 30 days. The cost of the merchandise was $830. So here again, we're going to have, when we're selling merchandise, we have two transactions. We need to record the sale and the cost of sale. So on 531, we need to record the revenue, and that sale was $1280, I think. Let's see here. Yep, $1280. So let's record the sale, and it was on account, even though there weren't any discount terms. So we're going to debit accounts receivable for $1280 and credit our sales. That's a revenue account. Crediting it makes it go up to record sales on account net 30. So they just have 30 days to pay. And then this is only the first entry. So we've recorded the revenue. And so now we need to record the expense side. So the date is the same, 5/31. And we're going to debit our expense, cost of goods sold. Debiting that expense makes it go up, $830. And we're going to credit our merchandise inventory. Whoops, I need to move that over. Let's credit our merchandise inventory. That's an asset. Crediting it makes it go down, which makes sense because we no longer have this asset. Our customer has it, to record cost of sale. Now, I'm going to make up a transaction because we have not covered it and it's important to cover it. I'm going to assume that with this sale, our customer called us and said, we sent a slightly different quality than they had ordered, and they would like a cost reduction. And we, or maybe could even be that it arrived slightly damaged, but it can still be sold. Maybe we sent the wrong color, but they still want to keep it and sell it. We call that, when we give a price reduction, we call that an allowance. That's the accounting language for it, an allowance. So let's say we gave $100 allowance for the fact that this merchandise wasn't quite up to snuff. So we're going to give them an allowance. Unlike a merchandise return, when we had a return, we had 2 journal entries. Why? Because we had to record the fact that we got the merchandise back. When we have an allowance, which is just a price reduction, let's say that happened on 5/31, we only have 1 journal entry for an allowance. We still have to debit sales returns and allowances because we just reduced the prices for our customer. And that is the allowance piece, but it's still a debit. So we're going to debit that $100, and they are going to take that off the bill. They have not paid their receivable yet. So we are going to credit their accounts receivable $100 and make it go down. So let's just be clear. We have an accounts receivable from this company, and we debited it when we made the sale, and we credited it here when we gave them the allowance. So we made it go down, and this was the sale. So this is to record allowance on defective merchandise or incorrect merchandise. So why did I show you the T account here? Because I'm not going to pay this, but I want you to be careful to remember this company didn't have a discount, so it's just going to pay $11.80. But if the company were entitled to a discount, make sure that you reduce the sale by the allowance and take the discount on the net amount due. Okay. All right. Let me just talk about the other side of this. This was a sales allowance. This was an allowance when you were the seller. Here you were the seller, and so you were giving your customer a discount. What if you had purchased merchandise? Let's see, where did we purchase merchandise last? I think we purchased up here on the 27th. We purchased some inventory. Oh no, that was when we paid the bill. So let's take the one up here on the 25th, the 800. Let's take this one here. Whoops. Oh, well, let's see if I undo that, if it'll go back. Oh, darn it. This is where it gets tough to kind of retrofit it here. All right, so let's just say that we were not happy with the merchandise here, the $800. And so, oh, that's interesting. I thought we had paid cash for that. No, I guess we didn't. So, well, that's good because I actually wanted to talk about if it was accounts payable. Let's say we were not happy with that merchandise. And so we called our vendor and we said, we're not happy with this merchandise. We still think we can sell it, but we're going to have to discount it. We would like to have, a discount of 10%. And they say, yep, sure. We will give you a credit memo for 10%, an allowance for 10%. If this is what you received and it was your inventory and you were the buyer, your journal entry to record that would be to debit your accounts payable for your $80, decreasing it, right? Because you haven't paid the bill yet, and you're going to take it off your bill. You're not going to pay them $800. You're only going to pay them $800 minus the allowance they gave you. And then you should credit your merchandise inventory, because that merchandise inventory needs to go down by the allowance, because that merchandise inventory didn't cost you $800. It's actually only going to cost you $720. So your merchandise inventory account, we debited $800 when we made the purchase. When we have the allowance, we want to credit it. This was our allowance, and our merchandise inventory now shows $720. Okay. So I think that concludes this marathon video here on merchandising transactions. And I think we covered everything in this problem that we would be holding you responsible for with journal entries. Remember, what's really challenging is that in this chapter, you have to stand in both shoes. Sometimes you are the purchaser of merchandise inventory, and sometimes you are the seller of merchandise inventory. So be very, very careful when you approach a question that you know what you're being asked to do. Are you the buyer or are you the seller? Because there is someone on every single side or the other side of every single one of these transactions, and they account for things differently because they're on the other side. But you learned how to account for it from both sides. And particularly in this entry, we did both multiple times. So you should be in good shape. The other major part of this chapter is working with a multi-step income statement. Good luck. Please pay attention to that too, because we only worked with a multi-step up until this chapter, and now our income statement no longer looks like it did before. So thanks for watching. I hope that was helpful.